what we see happening from governments around the world in their response to COVID is, significant ramp up in fiscal stimulus, and most of that's coming via, protecting incomes. And I think it's very important to distinguish between by the size of the stimulus. And Western governments have typically spent, or are in the process of spending a lot more than what China has announced to date. Now, there's a bunch of different reasons for that, but the primary one is that China has simply been far more effective in sort of dealing with the virus versus the US and some of the more, let's call them open economies around the world. Now, Europe is tending to pay companies to keep people employed, whereas the US is tending to pay workers greater unemployment benefits. And I think that's it's important to make that distinction. The 30 million unemployed people in the US at the moment are typically getting a pay rise as they become unemployed. The typical benefit, we're talking about almost a doubling of their incomes. So the question will be that top up expires at the end of July. Given the social unrest in the US, I think it will be very difficult for Democrats or Republicans to take that away until there's a more sustainable recovery. Slide 4 just sort of paints the backdrop that we've been observing for some time, and in the drawdown that we had in March, credit protection against a high yield was, in our shorts on some of the credit sensitive equities did very well in the fund. The issue that we see is that in both the US and in Europe, the corporates that are borrowing on average are getting worse and worse in terms of their ability to sustain that debt. And you can see that as the growth in the 3 bars below investment grade. So BBB, high yield and leverage loans keep growing as a share of the corporate debt stack, as the best companies don't need to borrow money. And equity markets, as you know, have become very narrow. A few winners doing well versus, the rest. And that's a reflection of just the pressure that's on, the profits of some of the companies, or the majority of companies that are increasingly under disruptive pressures from the large internet companies. Slide 4 just takes that narrative a little bit further, and over time we've been highlighting that QE in some ways reinforces wealth disparity, it reinforces populism, it doesn't necessarily stimulate greater economic growth without fiscal stimulus. And COVID-19 has really fast forwarded this cycle towards fiscal activism. And I think in that sense, you're actually probably going to an environment where governments and central banks are potentially going to work much more closely together. That's what we need to watch from a recovery perspective. Now, where we end up in terms of, given the size of the government debt that's been built up now, and the weak position that some economies like the US were in from a fiscal perspective going into this. How that impacts currencies is something to keep an eye on. Our view is that the US dollar in the longer term will be structurally weak as US government debt to GDP just continues to expand from this point. Look, the backdrop for, let's call it conventional value investing, has been extraordinarily tough in terms of headwinds. Lower multiple stocks systematically have underperformed now for the last 3 years, and the underperformance has accelerated, in recent times, and has become quite extreme year to date. So traditional lower multiple stocks are down from an alpha perspective, have had negative 19% versus growth and profitability year to date up roughly 2% and 9% respectively. Now, the issue is what's the path forward? Can growth stocks or quality stocks can they just become more and more expensive? Is there a limit to their outperformance? You're already operating at a relatively, if you look at slide 7, where we break the global equity universe down into different types of companies. We have in our first group there, the global cyclicals, where you can see the Antipodes portfolios in the long book are slightly, we are invested actively long versus the benchmark. Probably most interesting on this chart is just how big the global defensive bucket is now relative to the cyclicals. So it's almost double the size, and they are the software companies, healthcare, and consumer staples. So some of these cyclical parts of the market have just shrunk to, if you add up all the market cap of hardware, energy, industrials, all of materials, you don't have much market cap anymore. And I think there is a limit. We would argue that capital markets ultimately do allocate capital, and when sectors go through tough times, you will have capital leave, which ultimately rebalances supply and demand. But you do have secular changes, and we're very aware of that as a pragmatic value manager. So we've adopted more of a barbell approach to managing this environment of these extreme style biases. And, PE dispersion, the difference between the multiple being applied to very high PE stocks versus very low PE stocks. It's pretty much as extreme as it's been in any, in the history of investing. So it is a fairly remarkable environment. So the barbell has kept us somewhat in the game, where, we think it's, there are definitely opportunities in the loser bucket. But we also have to be open to, the real secular changes that are taking place. Slide 8 will, give you a sense of how we're thinking about the reopening of the economies. We have stage 1, obviously the lockdown, where many of the secular winners actually just got another injection of steroids in terms of the adoption of e-commerce, the adoption of food delivery. And that's been good for our Facebooks, which is the social network that is most geared into e-commerce spending in terms of advertising, in terms of Uber actually operating relatively well in this environment, even though their rides business has been tough. They've picked up quite a lot of business on the food delivery side, and our Chinese e-commerce stocks doing very well. Now, the stage 2 is going to obviously involve some of the stocks or areas of the market that have been hit hardest by COVID, being aerospace, travel and leisure, financials. We should start to see some outperformance or recovery from the stronger companies, the companies that have come through that in better shape. The medium term is really going to be what happens in the medium term, I think, is going to be a function of how successful governments are transitioning from, let's call it, income stimulus, which, let's face it, doesn't actually create investment. It doesn't create, all you're doing is replacing income lost, to investment stimulus. Now, we think in many ways the Chinese, and to a lesser extent the Europeans, are probably in a better place than the Americans. Not because America doesn't respond. It's simply that we think there's already programs in place that allow the Chinese and the Europeans, with their plans for decarbonisation, to pivot, to shovel, let's call it shovel-ready projects. Whereas I think in the US, given the way the economy functions, given it's far more capitalist in nature, won't necessarily have those, shovel-ready projects, at hand. It will get there, but it may take more time, and it may need, a lot more private, public-type partnership projects to be put in place, which takes time. So we don't see life necessarily going back to normal as economies reopen. Corporates, I think, will be very frugal in terms of re-employing people. They'll accelerate the adoption of software. They'll look hard at office space. In retail, if you haven't already pivoted to omni-channel, I suspect you won't have a business. And, you know, it's really looking at how some of the extreme valuation dispersion may start to mean revert in portfolios. And slide 9 summarises how we've positioned the portfolios. Now, this is the outworking of, you know, this is what we've been doing over a number of years. But there will be a time to start to pivot from, let's call it the stage 1 beneficiaries, the social commerce software cluster, some of the pharma stocks that have done well, to some of the stage 2 and 3 beneficiaries. Now, new and old energy, we think this is a very exciting cluster. You might be surprised to hear that in regards to old energy, but, you know, COVID in some ways has accelerated the supply rationing that's happening in the oil market. So shale, we think by within 12 months' time, the US will be structurally producing 3 million barrels less than it was at the peak, simply because shale has really had capital. Capital is being pulled out of shale because of the lack of cash flow, the lack of return. So we think energy or oil has become a supply side story. New energy is what the Europeans are doing in terms of decarbonisation and incentivising utilities to deploy capital away from coal towards cleaner energy like wind, like solar, and even gas as replacement for baseload. EDF, RWE are great ways to gain exposure to that. The secular industrials, these, in the case of GE, it's been hit by aerospace, but we think it comes through. Travel is slowly starting to normalise. It's going to come back slowly because domestic travel will come back faster than international travel. But the business, we believe, has the strength of does have the balance sheet, will be able to get through this period. And we ultimately believe it's the best, it's the highest quality aerospace, and let's call it healthcare, the highest quality aerospace business, and a very strong healthcare business. The retail banks, in a value rally, you have to think banks will participate. It's not a question of just broadly buying any bank. We believe you'll do much better in retail-oriented banks, and we are ones that ultimately have some pricing power. And it means that, in a world where central banks are holding down rates, NIM compression is a real risk. So we'd rather own the banks that have actually already gone through a very tough period in that respect. And that leads us to European and Korean banks rather than US banks, where you could argue those super low rates are really only, you're at the beginning of that, that period rather than the end. We've had negative rates in the US, in parts of Europe for some time. So on the other parts of the portfolio that will tend to do better, I think, as governments move towards infrastructure, one stimulus, probably the Americans, they don't really care. There's not a lot of consensus between Democrats and Republicans, and we're going to see even less consensus as we approach the election. And it will be interesting to see how these riots, whether they morph towards more of a discussion around equality and, the social wage that many of these unemployed people are getting. I think it will be hard to take it away, which means that you may get more wage inflation in the US because you're actually competing against corporates in terms of attracting labour back into the workforce. So you have to watch that space very carefully because you're keeping demand, you're protecting demand, but you may be pulling away labour supply from the economy, and that may be more inflationary than the market currently expects. Plus, you will have, I think, a lot of ongoing negative headlines around the US's relationship with China, because there will be this significant blame game. I think it's probably best to ignore them, because ultimately, I think they will be the threats from the US will be somewhat hollow. The capacity to follow through is, I think, somewhat limited by the weaker economic environment that the US faces today versus at the height of the tariff war, when the US was in relatively good shape. So wrapping up, I think the part of the US where they can stimulate would be 5G. They want to accelerate 5G adoption, as does Europe, as does China. All of these regions see it as a part of their national security, and it's having stocks in the portfolio like STMicro, Qualcomm, Samsung that benefit from that type of investment, a combination of 5G, cloud, and EV enablement. Governments will want to accelerate the adoption of these new technologies as a way of creating, let's call it, investment aggregate demand to offset the worst of COVID. So that wraps it up from my end. The next couple of slides just give you some further information in how we're invested long and short from a factor perspective, and also from a currency positioning perspective. But we do believe you are iterating slowly towards an environment that will be somewhat more favourable for value investing, or at the very least some mean reversion or some compression in PE multiples.